Ladies and gentlemen, let me start with a simple question. What if the biggest trade win of the decade is actually the trigger for the most expensive economic trap of our time? Because that is exactly what is unfolding right now. China has just secured what many are calling a 100 trillion trade victory, a realignment of global supply chains, capital flows, and strategic partnerships. But hidden beneath this headline is a far more uncomfortable truth. This move has activated a 17 billion trap originally set during the Trump trade war. And the most dangerous part is this: there is no clean exit. To understand why this matters, we need to go back to the trade war era. When tariffs were imposed, the goal was clear: pressure China, force manufacturing back home, and weaken Beijing's leverage in global trade. On paper, it looked tough. In reality, it forced China to do something far more powerful. It adapted. China didn't retreat, it redesigned its trade architecture, expanded partnerships across Asia, the Middle East, Africa, and Latin America, and quietly positioned itself at the center of a new economic gravity. Fast forward to today, and the results are undeniable. China's trade surplus has surged toward trillion-dollar territory, fueled by record exports, supply chain dominance, and currency management that keeps its goods competitive. This is not just growth, this is leverage. Every container ship leaving Chinese ports now carries more than products, it carries influence. And the irony is striking. The very pressure meant to weaken China has accelerated its rise as the world's manufacturing backbone. Now here's where the trap snaps shut. The tariffs imposed during the Trump administration are still largely in place, generating roughly $17 billion a year in revenue for the US government. Sounds like a win, right? But this revenue comes at a cost. Remove the tariffs, and the government loses billions instantly. Keep them, and American companies and consumers continue paying higher prices. This is the trap: tariffs that can't stay forever, but can't be removed without pain. This is why there is no easy exit. If tariffs are lifted, imports surge, domestic industries face renewed pressure, and inflation risks return. If tariffs remain, supply chains stay distorted, costs stay elevated, and global partners keep drifting toward China. Either choice triggers economic consequences. The system has locked itself into a dilemma where every move creates a new problem, and China benefits from both outcomes. China understands this perfectly. That's why it has doubled down on long-term contracts, trade settlements in non-dollar currencies, and regional trade agreements that bypass U.S. influence altogether. This isn't a short-term trade play, it's a strategic shift. While policymakers argue over tariffs, China is writing the next chapter of global trade rules, and it's doing so from a position of strength. The real story here isn't just about the US and China. It's about the world watching and adjusting. Nations that once relied on US-led trade frameworks are now hedging their bets. They see stability, scale, and predictability in China's trade networks. And as this shift accelerates, reversing it becomes exponentially harder. What was designed as economic pressure quickly became a catalyst for transformation. When tariffs were imposed with the intent to restrain China's rise, the underlying assumption was that higher costs and restricted access would weaken export competitiveness and force structural concessions. Instead, the opposite dynamic unfolded. Faced with external constraints, China responded not by retreating, but by accelerating adaptation. The moment access to the U.S. market became less predictable, Chinese firms and policymakers began treating diversification not as an option, but as a strategic necessity. Rather than relying on a single dominant buyer, exporters expanded aggressively into Southeast Asia, the Middle East, Africa, and Latin America. These regions were not merely replacement markets. They offered faster demand growth, infrastructure investment opportunities, and fewer political barriers. This shift reshaped trade routes, investment flows, and production strategies. What initially appeared as a defensive move evolved into a permanent expansion of China's commercial reach, reducing its vulnerability to any single economy's policy decisions. The pressure also forced a rapid restructuring of supply chains. Chinese manufacturers moved up the value curve, investing in automation, advanced logistics, and higher margin goods to offset tariff-related costs. At the same time, China strengthened its control over upstream inputs, raw materials, intermediate components, and processing capacity, making global production networks increasingly dependent on Chinese nodes. The result was not isolation, but deeper integration on terms that favored Beijing. Perhaps the most underestimated effect was speed. Trade barriers compressed decision, making timelines that might otherwise have taken decades. New trade agreements were signed, regional partnerships were prioritized, and financial mechanisms were developed to support exporters under stress. The learning curve was steep, but the payoff was lasting. Once supply chains adjust, they rarely revert. Buyers who establish new sourcing relationships, logistics networks, and financing structures tend to stick with what works. Here lies the central irony. Measures meant to slow China's economic momentum instead hardened it. Exposure to pressure reduced complacency, sharpened competitiveness, and institutionalized flexibility. While tariff costs were real, the long-term gains in resilience were larger. China emerged less dependent on any single market, better positioned to absorb future shocks, and more influential in shaping trade norms across emerging economies. The most critical lesson is not about tariffs themselves, but about incentives. Economic pressure rewards those who can adapt fastest. By forcing diversification, innovation, and strategic realignment, the trade war unintentionally strengthened China's trade architecture. What began as an attempt at containment ultimately became a rehearsal for economic independence, one that left China structurally stronger than before. A trade surplus approaching $1 trillion is not just an accounting milestone, it is a signal of power. When exports consistently exceed imports at this scale, the surplus transforms into a strategic asset that reshapes global relationships. Every surplus dollar represents foreign demand, external dependence, and influence embedded in supply chains. The real hook is this: such a surplus allows a nation to set terms rather than merely respond to them. At this magnitude, pricing power becomes structural. Chinese exporters can absorb short-term margin pressure, adjust invoicing strategies, or undercut competitors without destabilizing the broader system. This flexibility gives Chinese firms a decisive advantage in contract negotiations, especially in price-sensitive emerging markets. When global buyers face a choice between higher-cost alternatives and a stable, large-scale supplier, the surplus-backed exporter almost always wins. Scale becomes leverage, and leverage compounds over time. Currency dynamics amplify this advantage. A massive trade surplus generates sustained foreign currency inflows, giving policymakers greater control over exchange rate stability. This allows China to smooth volatility, manage competitiveness, and protect exporters during global downturns. The ability to stabilize the currency, while others face depreciation pressure, is not neutral. It attracts trade partners seeking predictability. In uncertain times, predictability becomes a currency of its own. The surplus also strengthens geopolitical influence in quieter but more durable ways. Countries running trade deficits with China increasingly align their economic planning around continued access to Chinese goods, capital equipment, and intermediate inputs. Infrastructure projects, long-term supply agreements, and financing arrangements often follow trade dependence. These relationships do not require formal alliances. They are enforced by economic gravity. Once a country's growth model depends on reliable trade flows, policy alignment becomes a practical choice rather than an ideological one. Perhaps the most overlooked hook lies in resilience. A surplus of this scale provides a buffer against external shocks, sanctions risk, and cyclical downturns. While deficit nations must constantly attract capital to fund consumption, surplus nations accumulate options. They can extend credit, redirect exports, or invest abroad to secure resources and markets. This optionality shifts negotiations from urgency to patience, a subtle but decisive advantage. What appears on the surface as a surplus is, in reality, a system of leverage woven into prices, currencies, contracts, and dependencies. At near trillion-dollar levels, trade ceases to be transactional and becomes structural. Influence is no longer asserted through confrontation, but through indispensability. When the global economy runs on your output, power does not need to announce itself. It is already embedded in the flow of goods. At first glance, tariff revenue looks like easy money. Billions flow directly into government accounts with little legislative friction, creating the impression of a policy that pays for itself. But this is where the illusion begins. The roughly $17 billion generated annually from tariffs is not free income. It is a byproduct of higher costs imposed across the economy. The hook is simple but uncomfortable. Every dollar collected is first paid by businesses and consumers, often invisibly, through higher prices and distorted supply chains. This revenue creates a fiscal dependency that quickly turns into a policy trap. Once tariffs are embedded into budget projections, removing them becomes politically and economically difficult. Governments begin to rely on this income to offset deficits or fund programs, even though the underlying source is economically inefficient. Eliminating tariffs would require either spending cuts, higher taxes elsewhere, or increased borrowing, all politically costly choices. What was introduced as a temporary measure becomes structurally permanent. The trap deepens when inflation enters the equation. Tariffs raise input costs for manufacturers, which then pass those costs down the supply chain. Consumers absorb the final impact, often without directly connecting price increases to trade policy. When inflation rises, policymakers face pressure to reduce costs, but removing tariffs risks a sudden surge in imports that can disrupt domestic industries. This leaves decision makers boxed in: keep tariffs and fuel price pressure, or remove them and destabilize production. Corporate behavior further complicates the exit. Firms adjust to tariffs by redesigning supply chains, renegotiating contracts, and reallocating capital. Once these adjustments are made, reversing policy does not instantly restore efficiency. Companies that invested heavily to adapt to tariffs may resist their removal, while others have already passed costs permanently into pricing structures. The economy absorbs the distortion, and the distortion becomes normalized. The most dangerous hook lies in perception. Tariff revenue creates the appearance of strength, suggesting leverage over trading partners. In reality, the burden is largely domestic, while foreign exporters often adjust through pricing, currency shifts, or market diversification. Over time, the leverage erodes, but the fiscal reliance remains. The government is left collecting revenue from a policy that delivers diminishing strategic returns. This is why the tariff revenue functions less like a tool and more like a constraint. It locks policy into a narrow corridor where every alternative carries a visible cost. The longer the system depends on this income, the harder it becomes to unwind without economic disruption. What began as a tactical move evolves into a structural dilemma, one that limits flexibility precisely when adaptability is most needed. Trade policy rarely fails because of intention. It fails because of trade-offs that cannot be escaped. The dilemma surrounding tariffs is a textbook example of this reality. On one side lies the option of removal, which appears pro-growth and market-friendly. On the other side is continuation, framed as protection and leverage. The hook is that neither path resolves the problem. Each simply shifts the pressure to a different part of the economy. If tariffs are lifted, import costs immediately fall, and foreign goods flood back into the market with renewed competitiveness. For consumers, this initially feels like relief. Prices stabilize, choice expands, and inflation pressure eases. But beneath the surface, domestic producers face an abrupt shock. Industries that have adjusted to tariff protection find themselves competing against lower-cost imports without adequate transition time. Investment plans are delayed, employment becomes vulnerable, and political backlash quickly follows. What looks like a pro-consumer move risks becoming an industrial destabilizer. Keeping tariffs in place, however, carries its own structural cost. Supply chains remain distorted as firms source inputs based on tax avoidance rather than efficiency. Capital is allocated to workarounds instead of productivity, raising long-term production costs. These inefficiencies accumulate quietly, embedding higher prices into everyday goods. The economy adapts, but at a lower efficiency frontier. Growth continues, but it is slower, more expensive, and increasingly disconnected from global optimization. The most uncomfortable hook is that time does not solve this problem, it deepens it. The longer tariffs remain, the more deeply businesses, logistics, networks, and pricing models adjust around them. Removing tariffs later becomes more disruptive than removing them earlier. Yet removing them early carries immediate political and economic risk. Policymakers are forced to choose between short-term shock and long-term drag. Knowing that neither option avoids pain, global reactions further complicate the exit. Trading partners retaliate, diversify, or permanently shift supply chains. Once alternative networks are built, they are rarely dismantled simply because tariffs disappear. This means that lifting tariffs does not automatically restore lost export markets or influence. The leverage assumed to exist on paper often vanishes in practice, while the costs remain real and measurable. This creates a policy deadlock where action and inaction are equally costly. Every decision introduces a new imbalance, and every delay compounds existing distortions. The economy is not frozen, but it is constrained, operating within boundaries shaped by past choices. In this environment, the absence of a clean exit is not a failure of execution. It is the logical outcome of a policy that trades flexibility for control, and then discovers that flexibility is the most valuable asset of all. Global trade power rarely collapses in dramatic fashion. It erodes quietly as alternatives become normal. That is exactly what is happening as trade networks gradually reorient away from US-centered systems. The hook is subtle but decisive. Control is not being challenged directly, it is being bypassed. Countries are not abandoning existing frameworks out of defiance, but out of necessity, efficiency, and risk management. As trade tensions increased and policy uncertainty became persistent, governments and corporations began treating concentration risk as a liability. Reliance on a single dominant trade system, currency, or regulatory environment exposed economies to political decisions beyond their control. In response, nations diversified partnerships, settled transactions through regional agreements, and prioritized continuity over alignment. This was not ideological, it was pragmatic. Stability in trade matters more than symbolism when supply chains and growth are at stake. Regional trade blocs accelerated this shift. Agreements across Asia, the Middle East, and parts of Africa reduced tariff barriers internally while simplifying rules of origin and payment mechanisms. These arrangements made it easier to trade within regions without routing transactions through US-influenced channels. Over time, firms naturally gravitated toward systems that minimized friction and uncertainty. Once trade flows adjust to these structures, reversing them becomes economically irrational. Currency usage reveals the depth of this realignment. While the dollar remains dominant, a growing share of trade is now settled in local or alternative currencies. This reduces exposure to exchange, rate volatility, sanctions risk, and external monetary policy. The hook here is not replacement but redundancy. Even partial diversification weakens centralized control because leverage depends on exclusivity. When options multiply, influence diffuses. China's role in this transition has been catalytic. By offering scale financing and long-term contracts, it provided a ready-made alternative for countries seeking reliability. Infrastructure investment, energy agreements, and industrial partnerships reinforce these trade ties, embedding them into national development plans. The result is a network effect. The more countries participate, the more attractive the system becomes to others. What makes this shift especially powerful is its invisibility. There is no formal announcement of departure from US-led trade dominance. Instead, contracts are signed, settlements rerouted, and standards quietly adjusted. Policymakers often realize the loss of influence only after decisions stop requiring their approval. Influence fades not when it is challenged, but when it is no longer needed. This realignment does not imply decline in absolute terms, but it does signal reduced centrality. Trade power today is less about command and more about indispensability. As the global economy builds parallel systems designed to function without US mediation, the balance of control changes by default. What emerges is not a single replacement hegemon, but a fragmented landscape where influence is shared, and therefore weaker for any one player. Trade wars are often framed as contests of strength, but history shows they are tests of flexibility. The decisive advantage rarely belongs to the side that applies the most pressure, but to the one that adapts fastest under it. The hook lies in this reversal. Economic aggression exposes vulnerabilities not only in the target, but in the aggressor's own system. Those who recognize this early reshape their strategy. Those who do not remain trapped in escalation. Adaptability in trade policy operates at multiple levels. Firms reconfigure supply chains, governments renegotiate partnerships, and financial systems adjust settlement mechanisms. Economies that enable these shifts quickly convert disruption into opportunity. When constraints appear, they treat them as signals to innovate rather than barriers to defend against. This mindset transforms external pressure into an internal upgrade, strengthening competitiveness over time. China's response to trade pressure illustrates this dynamic. Rather than concentrating resources on retaliation alone, it focused on reallocation, redirecting exports, deepening regional integration, and investing in technological self-sufficiency. These moves reduced dependence on any single market while increasing relevance across many. The pressure did not disappear, but its impact diluted. Each adjustment made the next shock easier to absorb, creating a compounding resilience effect. Aggressive trade measures, by contrast, often assume static behavior from partners. Tariffs, quotas, and sanctions are designed to force compliance, but they also incentivize workarounds. Once alternatives are built, they persist. The hook here is that pressure accelerates the search for substitutes, and substitutes permanently weaken leverage. What begins as a show of strength can end as a lesson in diminishing returns. There is also a domestic dimension. Economies that emphasize adaptability invest in skills, infrastructure, and policy flexibility, allowing businesses to pivot without systemic shock. Those that rely primarily on protection risk entrenching inefficiency. Over time, protected industries innovate less, costs rise, and competitiveness erodes. Adaptability rewards openness to change, even when that change is uncomfortable. The global economy amplifies this effect. Capital, technology, and logistics flow toward environments that minimize friction and uncertainty. Nations that demonstrate agility attract investment and partnerships, while rigid systems struggle to retain relevance. In this context, adaptability becomes a form of economic credibility. It signals to markets that shocks will be managed, not magnified. The most powerful hook is that trade wars do not end when policies change, they end when structures adjust. Once an economy has diversified markets, localized production, or alternative payment systems, the original pressure loses force. The contest is no longer about who can impose costs, but about who can evolve fastest. In that race, adaptability is not a defensive tactic, it is the winning strategy. So here's the uncomfortable conclusion. China's $1 trillion trade win didn't just boost its economy, it exposed a structural weakness in the global trade strategy designed to contain it. The $17 billion tariff trap remains active, binding policymakers to decisions made years ago. And the harsh reality is this: there is no painless way out, only choices between costly options. In the new economic order taking shape, the question is no longer who started the trade war, but who adapted fast enough to win it.